You've been calling for it, and it seems like it is here. The housing crash that everybody has been waiting for. Is this the start of it? Or is this a sign that people aren't able to afford houses? Mortgage prices are way too high, and there is a potential jobs crisis alert. We're going to break this all down. But first, we need to talk about how this is the first time in a long time we are starting to see the housing prices start to decline. They've now fell across America's 20 largest cities, nearly 0.1% month over month. And the decline is not as much as expected, but it's still declining. So this marks the fifth consecutive drop, the second in 14 years. And then, however, the prices are still up year over year, but they're coming down a little bit, just above 1.8% year over year. Meanwhile, the home values adjusted for inflation record their third consecutive monthly decline. Now, when they're adjusting for inflation, you got to ask yourself, what metric are they using for inflation? Because it seems like there are a few different things going around, right? There's the CPI, the PCE, all of these different numbers. Now, the reality is that the amount of money supply, the M2 money supply, when it's going up like this, housing has been declining for quite some time. And when you compare it to the S&P, it's declining as well. So really depends on what you're looking at. And the inflation is more aligned with the S&P than it is with those other numbers. But regardless, the prices are still going up relative to, the way the dollar is. And so if you look at it, the housing price index is now down, and it's up 2.3% of last year, but it fell that 0.1%, which was nice. So is this the start of where we're going to start to see major housing markets, like where I am in Tampa Bay, fall? But there is a rise in other areas. So, of course, everybody in the real estate market always loves to tell me, hey, Brandon, look, real estate, it's dependent on your market, which I'm not going to argue with. It's like saying, all right, speaking in generalities about the stock market, but being able to find some sort of, stock that is doing all right. Well, I mean, it's the same kind of thing with housing, except housing is just even more regionalized than, say, the stock market. But that's beside the point. Some of the biggest markets that shot a skyrocket up are now seeing major housing prices fall. Now, if you look at the housing prices, they need to fall 40% or incomes need to rise 60% to get to the affordability levels that we saw in 2019. Now, for those of you guys who, maybe stink at doing math, 2019 was just 6 years ago, folks. So why is it that we're seeing such a dramatic shift in the affordability? Well, in my opinion, it's not only the devaluation of the currency, but it's also the jobs crisis that I've been talking about so much on this channel. And if you guys have been coming around, please hit that subscribe button for me and help me get to 500 or 400. I'm almost there, just under that. So help me reach that. And we're going to continue talking about from breadwinners to bystanders, the death spiral of the American working man, because America's job market, young men with college degrees are struggling to find work. What once seems fixed, the old order of men filling the top jobs has been flipped. So men with college degrees likely out of work with the same education. So now it seems like there's some ebb and flow with the overall jobs market, but housing is a combination of jobs and affordability. So the mortgage rates would also need to come down, as well as their job salaries would need to come up. And we're seeing that mortgage rates are actually showing a decline. They're some of the lowest that we've seen in more than a year. Yet mortgage rates keep on dropping, and the Fed is still lowering those interest rates. But reality is, even with these mortgage rates where they are still a lot higher than what majority of homeowners have their mortgages in. Majority of homeowners have their mortgages under 4%, and they're not looking to sell. So it's not necessarily a, hey, there's this major crisis where everybody needs to sell homes because we're in a huge recession. No, no, no. Of course, we're seeing insurance prices raise up. We're seeing taxes raise up because home prices are appreciating. But if you decide to sell your house and move to something else, well, you're going to be paying more in mortgage rates. So the housing market is still very stagnant. We are not seeing a ton of buyers coming in. And then we're seeing the potential of more inflation coming. Well, look, I mean, I love Donnie T and a lot of his policies, but this one, not so much, where he's considering providing taxpayers with a $1,000 to $2,000 stimulus check using tariff revenue. Whereas if you look at the overall tariff revenue and compare it to this right here, this US debt clock, one of my favorite things to show. Well, what the heck? It's not letting me close this little thing, but either way, you're seeing it at $37.5 trillion, and it won't let me close this secret window. So everybody tweet at freaking US debt clock. But either way, what we are seeing is that there's going to be potentially more inflation. Now, for those of you guys who keep coming around, know I keep covering the chance of cutting interest rates. And man, oh man, is that a near certainty here, where we have a 97.8% chance to cut interest rates with a 2.2% chance to stay. Now, the other day I was looking at this, and we actually had a percent chance where we were going to cut almost, we were almost going to cut 50 basis points. Now, we've moved back down to just one. But it's interesting because of what else we're seeing in this market. Retail investors are loading up on the stock market, and they are avoiding the housing market at all cost. And as McLovin is saying in the chat, the housing market's a train with greased up tracks while everybody's trying to get into more liquid assets like the stock market. So they're looking at individual investors buying equities in 21 of the last 24 weeks. So they're loading up big time. Why? Well, they see something that is coming out, right? They see the amount of the potential of raising or of lowering interest rates. And what does that mean? That means the stock market's going to go up. At least that's what everybody's thinking. That's what it's priced in. Retail has been net buyers. And this is the second most bullish week of 2025 for options activity as well. So individual investors and retail appetite, risk appetite has never been stronger. All of while we have housing costs are so high that we have, Americans delaying milestones like getting married and having kids and adopting a pet because of the way that this is just continuing to go. So it's interesting where we've now seen a lot of deterioration of that labor market. And we also see this, which I think is very interesting too, the quote, second job searches on Google increasing at a very rapid rate. Because not only do we have a jobs crisis, but we have a jobs and a wages crisis where they're not necessarily able to keep food on the table with the current job that they have. So because they can't keep food on the table, they're going to be looking at other ways to potentially increase their revenue. So what are some of these other ways that they're going to be looking at? Well, they'll be looking for a second job, whether that's driving Uber, whether that's doing a various other tasks. So because these other tasks are now going to be opening up and being looked at as, hey, ways to make more money, well, that's all leading up for a recipe of a disaster. And all of which, while the Dixie, the dollar, it's not showing massive amounts of strength. We're sitting at almost at 97.8. And so we're going to be watching and monitoring this, especially if the United States decides to cut interest rates. Of course, like I said before, this is almost a certainty, but the market likes to price in interest rate cuts. And seemingly the market has priced in 3 cuts. At least that's what the rumor on the street is. It's priced in 3 cuts. And today was one of the first days we've ever closed over 6,700. So the S&P is hitting all-time highs, even though we are seeing massive amounts of job loss. We are seeing the US government shooting down, and everybody is not so worried. The US government shutdown is expected to last for 13 days. And guess what? The market is loving it. I mean, the market is having a great day with the US also starting to, have this skyrocket up. Now, I'm going to cover a little bit more on this market, or on the government shutdown, excuse me. So make sure you guys are hitting that subscribe button. But there's a lot of things that the news doesn't cover about the government shutdown that I think a lot of people are getting incorrect with all of this. It's that, in reality, there is the average government shutdown is about 8 days. So they think that this is going to be nearly double that. At least the odd makers. The S&P ends higher 1 year later, 86% of the time. So markets love when the government shut down. They love it. The S&P 500 posted an average gain of 13% after the year end. During the last shutdown, the stock market rallied for 11 plus. And that last one was 35 days. So that was the longest government shutdown in history. And they're already priming us to be the second longest government shutdown in history. And so while as this is shut down, the government actually saves money, $400 million a day. And then that generally turns to more dovish it defers 400 million, sorry about that. But the Fed generally turns more dovish when government data is released. And well, the government data is going to be delayed because of this. So it's interesting to see that this delay doesn't have anybody super worried about this. But, we do see precious metals like gold and silver also shooting up. A lot of these inflation hedges, everybody doesn't seem to be too concerned with this government shutdown. They think everything could run pretty efficiently on its own. I wonder why. I mean, we just had a giant, essentially, shutdown not too long ago. And we are also seeing now a record amount of homes for sale as well. So in the southern United States, which saw a giant influx during the cerveza sickness, there's now 312,000 homes for sale. That's 21,000 higher than the 2006 peak. So the number of new houses for sale in the South was about half during the pandemic. And now the new homes for sale in the West have risen by 40,000. So it's interesting because they all have been saying, hey, you know what? It's an inventory issue. If you look at the numbers, man, the numbers tell a different story. McLovin is saying this is 100% expected for a nation holding the world reserve currency. It never ends well. Amen to that. I'm going to be detailing it all here. So make sure you guys are smoking that like, hitting that subscribe button for me, telling a friend to tell a friend, and I'll catch you guys all at the next one.